There's a system that has held the global economy together for 80 years. A system of cooperation between central banks that prevented currency wars, coordinated monetary policy, and kept the world trading in relative stability. And that system just collapsed. Not gradually, not with months of negotiation, suddenly, completely, in a way that fractures the entire foundation of global finance. In 1971, the Bretton Woods system collapsed when President Nixon ended dollar convertibility to gold. The result was a decade of inflation, currency, chaos, and economic stagnation that destroyed wealth across the developed world. In 1985, the Plaza Accord brought the world's major central banks together to manage currency values. When that coordination broke down in the early 1990s, it triggered currency crises across Asia, Russia, and Latin America. Trillions in wealth destroyed. In 2008, central banks coordinated the largest monetary intervention in history, the Federal Reserve, European Central Bank, Bank of Japan, Bank of England, all acting together to prevent global financial collapse. That coordination saved the system. This time, the coordination is ending, not by choice, by force. The central banks are breaking apart. The Federal Reserve is pursuing policies that contradict the European Central Bank. The Bank of Japan is moving opposite the Fed. The People's Bank of China is actively working against Western monetary policy. The system that prevented chaos for 80 years is fracturing. And when central bank cooperation collapses, currencies become weapons, trade becomes warfare, and the global monetary system enters a period of chaos that destroys everything built on stability. This is the story of how central banks kept the world stable, why that cooperation is ending, and why the fracture that just happened will reshape global finance in ways most investors cannot imagine. And it's happening right now. Welcome to Boring Economy, where we explain the systems that actually run the world. Look, you didn't come here for surface-level financial news. You came here because you understand that the real forces shaping markets happen behind closed doors, in Basel, in Jackson Hole, in coordinated statements from central banks that most people ignore. If you want to understand the architecture of global finance, not just the daily noise, hit that subscribe button right now, smash that like button, because what I'm about to show you is the kind of analysis that changes how you see everything. And when this monetary fracture goes from hidden to obvious, when currencies start moving in ways that shock everyone, when the coordination that held everything together is clearly gone, you'll already understand why. You'll have been prepared. Now, let's talk about what central banks just did and why it shatters 80 years of monetary cooperation. 3 days ago, the Federal Reserve, the European Central Bank, and the Bank of Japan issued policy statements within hours of each other. On the surface, routine announcements, interest rate decisions, economic projections, forward guidance. But hidden in those statements was a message that should terrify anyone who understands how the global monetary system actually works. The central banks are no longer coordinating, they're no longer communicating their plans to each other in advance, they're no longer trying to prevent currency volatility or manage exchange rate stability. They're acting independently, pursuing conflicting policies, moving in opposite directions, and when the world's major central banks stop coordinating, when they stop working together to maintain stability, the result is always the same. Currency chaos, trade wars, competitive devaluations, economic disruption. The Federal Reserve is maintaining high interest rates to fight inflation, 5.5%, the highest in 16 years. They're keeping policy tight despite economic weakness because inflation is still above target. The European Central Bank just cut rates. They're easing monetary policy, lowering borrowing costs, trying to stimulate a European economy that's teetering on recession. They're moving opposite the Fed. The Bank of Japan is stuck at zero. They've tried to raise rates but can't. Their economy can't handle higher borrowing costs. They're trapped in ultra-loose policy. While the Fed is tight and the ECB is easing, 3 central banks, 3 completely different policies, 3 contradictory approaches. This is not coordination. This is fracture. Before we talk about what's happening right now, you need to understand how central bank cooperation actually worked, not the theory from economics textbooks. The reality, the backroom deals and coordinated interventions that kept the system stable for 80 years. Let me show you how it worked and why the collapse of that cooperation has always led to disaster. In 1944, the world's major economies met at Bretton Woods, New Hampshire, to design a new monetary system. World War II was ending. The previous system of competing currencies and trade wars had failed spectacularly. It had contributed to the Great Depression, it had fueled the rise of fascism, it had destroyed the global economy. The architects of Bretton Woods understood that monetary chaos leads to economic chaos. leads to political chaos, leads to war. So they built a system of cooperation, and the dollar would be convertible to gold at $35 per ounce. Other currencies would fix their exchange rates to the dollar. Central banks would coordinate to maintain these fixed rates. If a currency came under pressure, other central banks would intervene to support it. The system required trust, cooperation, communication, coordination. Stage 1 was the establishment of rules. Every country agreed to maintain currency stability within narrow bands. If the British pound started falling too much against the dollar, the Bank of England and the Federal Reserve would coordinate intervention. They'd buy pounds and sell dollars to stabilize the exchange rate. The system worked because everyone followed the rules. Everyone coordinated, everyone communicated. Stage 2 was the growth period. From 1944 to 1971, the Bretton Woods system enabled unprecedented global economic growth. Trade expanded, currencies were stable, businesses could plan long-term investments without worrying about currency chaos. The cooperation between central banks created predictability, and predictability enabled prosperity. Stage 3 was the breakdown. By the late 1960s, the United States was printing too many dollars. The Vietnam War was expensive, social programs were expanding, the federal budget was in deficit, but dollars were supposed to be backed by gold at $35 per ounce. Other countries started demanding gold for their dollars. They didn't trust the US to maintain discipline. The cooperation was breaking down, trust was eroding. Stage 4 was the collapse. On August 15, 1971, President Nixon announced the United States would no longer convert dollars to gold. The Bretton Woods system ended immediately. No negotiation, no coordination. Just a unilateral decision shattered the entire system. Currencies began floating. Exchange rates became volatile. The cooperation that had maintained stability for 27 years was gone. The result was a decade of chaos. Inflation hit double digits. Currencies gyrated wildly. The dollar lost half its value against gold. Oil prices exploded because OPEC demanded more dollars for the same oil to compensate for dollar devaluation. The global economy entered stagflation, high inflation, and low growth simultaneously. Unemployment rose. Standards of living fell. An entire decade of economic misery caused by the collapse of central bank cooperation. Now let's jump forward 14 years. By 1985, global monetary cooperation had been partially rebuilt, not through fixed exchange rates, but through coordination. The Plaza Accord brought together the G5 nations: United States, Japan, Germany, France, United Kingdom. Their central banks and finance ministers met at the Plaza Hotel in New York. The problem was the dollar had become too strong. It had risen 40% in 4 years. This was destroying American exports, creating massive trade deficits, threatening American manufacturing. The Plaza Accord was a coordinated agreement to weaken the dollar. All 5 countries would intervene in currency markets simultaneously, selling dollars, buying yen, Deutsche, marks, francs, pounds. Coordinated action to move exchange rates in a desired direction. Stage 1 was the coordinated intervention. Central banks sold billions in dollars over the following months. The intervention was massive, coordinated, effective. The dollar fell 30% against the yen in 2 years. 50% in 3 years? The agreement worked because everyone cooperated. Everyone followed through on commitments. Everyone communicated their actions. Stage 2 is the period of stability. From 1985 to the early 1990s, the major central banks maintained informal coordination. They communicated. They shared information. They coordinated interventions when currencies moved too far. The system wasn't perfect, but it prevented the kind of competitive devaluations and currency wars that had destroyed the global economy in the 1930s. Stage 3 was the breakdown of coordination. By the mid-1990s, the informal cooperation was weakening. Countries were pursuing independent monetary policies. The Federal Reserve raised rates in 1994 without coordinating with other central banks, and the Bank of Japan kept rates near zero while the Fed was tightening. The European countries were focused on creating the euro and ignored global coordination. The system was fracturing. Stage 4 was the Asian currency crisis. In 1997, without coordinated central bank support, currencies across Asia collapsed. The Thai baht fell 40%. The Indonesian rupiah fell 80%. The Korean won fell 50%. The lack of coordination meant no central bank stepped in to stabilize these currencies. No coordinated lending, no coordinated intervention, just every country for itself. The crisis spread to Russia in 1998. The ruble collapsed, and the government defaulted on debt. Then to Brazil, then to Argentina. One by one, emerging market currencies imploded because there was no coordinated central bank response, no cooperation, no stability, just chaos. The same pattern played out in reverse during the 2008 financial crisis, but this time, the central banks learned from past failures and coordinated the largest monetary intervention in history. In October 2008, the Federal Reserve, European Central Bank, Bank of England, Bank of Japan, Swiss National Bank, and Bank of Canada announced coordinated interest rate cuts, all 6 central banks cutting rates simultaneously. All moving together, all communicating, and all cooperating. The coordination continued for years. They all did quantitative easing. They all kept rates at zero. They all expanded their balance sheets. They coordinated swap lines so that dollars would be available globally. They shared information constantly. They made sure their policies supported each other rather than conflicted. Stage 1 was the coordinated rate cuts, October 2008. All major central banks cutting rates together, showing unified commitment to stopping the crisis. This coordination prevented competitive devaluations. It prevented currency wars. It maintained some stability even as the financial system was collapsing. Stage 2 is coordinated quantitative easing. The Fed bought trillions in bonds. The ECB did the same. The Bank of Japan expanded asset purchases. The Bank of England launched QE. All coordinated, all communicated, all designed to work together rather than against each other. This coordination flooded the global financial system with liquidity. It prevented deflation. It stabilized markets. Stage 3 was the coordinated exit from emergency policies. From 2013 to 2018, central banks slowly removed accommodation. The Fed raised rates gradually. The ECB ended QE slowly. The Bank of England followed carefully. They coordinated the pace of tightening to avoid shocking markets. They communicated their plans months in advance. They made sure everyone understood what was coming. This coordination prevented the kind of sudden policy shifts that cause market crashes. Stage 4 was the coordinated COVID response. In March 2020, when the pandemic hit and markets collapsed, central banks acted together again. The Fed cut rates to zero. The ECB expanded QE. The Bank of Japan increased purchases. The coordination was immediate, synchronized, effective. It prevented a financial crisis on top of a health crisis 3 times: 1971, 1997, 2008. 3 examples of what happens when central bank cooperation breaks down versus when it holds together. When cooperation fails, chaos. When cooperation works, stability. The pattern is clear. The evidence is overwhelming. Central bank coordination is the difference between a functioning global monetary system and complete chaos. Before we apply this to what's happening right now, you need to understand the mechanisms that make central bank cooperation actually work, not the theory, the reality of how coordination prevents disaster. Central banks control interest rates in their respective countries. The Federal Reserve controls US rates. The ECB controls European rates. The Bank of Japan controls Japanese rates. The People's Bank of China controls Chinese rates. When these rates diverge significantly, money flows from low-rate countries to high-rate countries seeking higher returns. This creates massive currency movements that can destabilize entire economies. If US rates are 5% and Japanese rates are 0, the math becomes incredibly attractive for investors. Borrow yen at 0% interest, convert those yen to dollars at the current exchange rate. Invest in US Treasury bonds earning 5%. The profit is 5% minus whatever currency risk exists. This is called the carry trade. And it's not small investors doing this, it's hedge funds with billions, investment banks with hundreds of billions, sovereign wealth funds with trillions. When massive amounts of capital engage in carry trades simultaneously, currencies move violently. The yen falls because everyone's selling it to buy dollars. The dollar rises because everyone's buying it with borrowed yen. These movements create enormous problems for the real economy. A falling yen makes Japanese exports cheaper in dollar terms. A Toyota that costs 3 million yen sells for $20,000 when the exchange rate is 150 yen per dollar. But it sells for $27,000 when the rate is 110. Same car, same cost to produce, but 40% cheaper to American buyers just because of the exchange rate. This gives Japan an unfair trade advantage Japanese manufacturers can undercut American competitors not because they're more efficient, but because their currency is weaker. American factories close. American workers lose jobs, not because of competition, but because of currency manipulation. A rising dollar makes American exports expensive to foreign buyers. Boeing sells a plane for $100 million. When the dollar is weak, that's affordable to airlines around the world. When the dollar strengthens 20%, that same plane effectively costs $20 million more to foreign buyers. They buy from Airbus instead. American exports collapse, the trade deficit explodes, manufacturing jobs disappear, all because of currency movements driven by interest rate differentials. Without coordination, this triggers retaliation. The United States sees Japan benefiting from a weak yen and accuses them of currency manipulation. Congress demands tariffs on Japanese goods. Trade barriers go up. Japan retaliates with barriers on American goods. Europe sees both the US and Japan fighting and imposes their own tariffs. China joins in, tit for tat, escalation. Before long, the global trading system is fragmenting into competing blocks with barriers and tariffs and restrictions, the kind of trade conflict that destroys prosperity, the kind that led to the Great Depression in the 1930s, when countries tried to beggar their neighbors through competitive devaluation. Central bank cooperation prevents this by coordinating interest rate policy before these conflicts develop. When the Fed wants to raise rates, they don't just announce it. They communicate with the ECB and Bank of Japan and other major central banks first. They discuss the implications. They explain their reasoning. They coordinate timing. They make sure the rate differentials don't become so large that they trigger destabilizing capital flows or create unfair trade advantages. This isn't charity, it's self-interest, because competitive devaluation helps no one in the long run. When everyone devalues, currencies just chase each other down, with no country gaining advantage but everyone experiencing inflation and chaos. This coordination also extends to intervention in currency markets. Central banks can buy or sell currencies to influence exchange rates, but intervention only works when it's coordinated. If the Bank of Japan tries to strengthen the yen by selling dollars and buying yen, they're fighting against market forces, trillions of dollars in carry trades pushing the yen down. One central bank can't overcome that. But if the Bank of Japan, the Federal Reserve, and the European Central Bank all intervene together, all selling dollars and buying yen simultaneously, the market notices. The intervention has power. It can actually move the exchange rate. When the yen was collapsing in 2022, falling from 110 to the dollar to 150 in a matter of months, the Bank of Japan didn't intervene alone. They coordinated with the US Treasury and implicitly with the Federal Reserve. The intervention was announced publicly. The timing was coordinated. It was done with the understanding that the Fed wouldn't immediately undermine it by making statements supporting a strong dollar. This coordination made the intervention effective. The yen stabilized, the carry trade unwinding slowed, the crisis was averted. Without coordination, the intervention would have failed. The market would have overwhelmed the Bank of Japan. The yen would have continued falling. The carry trade would have grown even larger, and the eventual unwinding would have been even more catastrophic. Cooperation also works through currency swap lines. These are agreements between central banks to lend each other currency during crises. They sound technical and boring, but they're essential to preventing financial system collapse. During 2008, European banks had made massive loans in dollars, loans to American borrowers, investments in American mortgage-backed securities. They had dollar assets, but their funding was in euros. When the crisis hit, when credit markets froze, those European banks desperately needed dollars to meet their obligations. But no one would lend them dollars. The interbank market was frozen. American banks wouldn't lend to European banks because nobody trusted anyone. The Federal Reserve solved this by providing dollars to the European Central Bank through swap lines. The ECB could then lend those dollars to European banks, and this prevented a dollar shortage from destroying the European banking system. If European banks couldn't get dollars, they would have defaulted on dollar obligations. They would have been forced to sell dollar assets at fire sale prices. This would have crashed asset values. It would have spread the crisis from America to Europe and back. The swap lines prevented this contagion, but they only worked because of trust between central banks. The Fed had to trust that the ECB would manage the dollars responsibly and return them eventually. The ECB had to trust that the Fed would provide enough dollars to actually solve the problem. That trust comes from decades of cooperation, from shared understanding, from communication and coordination built over years. Without that foundation of cooperation, swap lines don't exist, And without swap lines, the 2008 crisis would have been far worse, possibly civilization ending. The entire architecture of global finance depends on this cooperation. Currency stability depends on it. Trade flows depend on it. Banking system stability depends on it. Cross-border investment depends on it. When cooperation works, all these systems can function. Markets can operate, businesses can plan, investors can allocate capital globally. When cooperation fails, everything breaks. Currencies become volatile and unpredictable. Trade becomes risky. Banks can't get funding in foreign currencies. Cross-border investment freezes because currency risk becomes unmanageable. The global economy fragments into isolated national economies. Efficiency collapses. Prosperity disappears. This is why what's happening right now is so dangerous. Because the cooperation is ending, the communication is breaking down, the coordination is collapsing. And when it collapses completely, the global monetary system that enabled 80 years of growth and prosperity fractures into competing national systems. Now let's talk about what's happening right now in 2026 and why every sign points to the complete breakdown of central bank cooperation. Let me show you exactly where we are in the pattern that has always led to monetary chaos. Stage 1, policy divergence. Check. The Federal Reserve is maintaining restrictive monetary policy, rates at 5.5%, no cuts planned, hawkish stance on inflation. They're prioritizing price stability over growth. The European Central Bank is cutting rates. They've already reduced rates twice this year. They're easing monetary policy to support a weak European economy. They're prioritizing growth over inflation concerns. The Bank of Japan is trapped at zero. They tried to raise rates to 0.25% and had to partially reverse because the yen carried trade unwound. Violently, they can't move without triggering market chaos. The People's Bank of China is easing, aggressively cutting rates, and injecting liquidity, trying to stimulate an economy in deflationary recession. They're moving opposite everyone else. 4 central banks, 4 completely different policies. The Fed is tight, the ECB is easing, the BOJ is trapped, the PBOC is flooding liquidity. This isn't coordination. This is every central bank for itself. Check. Stage 2, communication breakdown. Check. Central banks are no longer telegraphing their moves to each other in advance. The ECB rate cut wasn't coordinated with the Fed. The Fed didn't know it was coming until the announcement. There was no consultation, no coordination. The Bank of Japan's intervention in currency markets in 2024 was done without coordinating with the Federal Reserve. They just did it. The Fed found out when everyone else did. The People's Bank of China is actively hiding their policy moves. They're cutting rates without announcement, injecting liquidity through mechanisms designed to be invisible. They're deliberately avoiding coordination. The annual meetings where central bank governors coordinate policy have become theatrical. They issue joint statements that mean nothing. They smile for cameras, but behind the scenes, they're pursuing contradictory policies. The communication that kept the system stable is gone. Check. Stage 3, currency warfare. Check. The yen has collapsed 40% from its 2021 highs, from 110 to the dollar to 155. This gives Japan a massive export advantage. Japanese goods are 40% cheaper in dollar terms. Japanese companies are crushing American competitors. The Bank of Japan says they're not trying to weaken the yen, but they're keeping rates at 0 while the Fed is at 5 and 2. 0.5%? The math is simple. The yen falls, Japan wins. And the Chinese yuan is being actively managed weaker. The PBOC is allowing the yuan to depreciate gradually against the dollar from 6.3 to 7.3. This makes Chinese exports more competitive. It helps China in its trade war with the United States. The depreciation is deliberate, strategic, weaponized. The European Central Bank is cutting rates while the Fed maintains high rates. This weakens the euro from 1.2 to the dollar to 1.05. European exports become more competitive. American manufacturers face cheaper European competition. This is currency warfare, not the shooting kind, the economic kind. Every central bank trying to weaken their currency to gain trade advantage. Competitive devaluation, beggar thy neighbor policy. The exact behavior that central bank cooperation was designed to prevent, and it's happening right now. Check. We're at stage 3 of 4. Bretton Woods reached stage 4 in 1971, when Nixon ended gold convertibility, and cooperation collapsed completely. The Plaza Accord system reached stage 4 in 1997, when the Asian crisis spread globally without coordinated response. We're one shock away from stage 4, one crisis that requires coordinated central bank action. And that action won't come because the cooperation is gone. Stage 4 is the complete fracture. This is what happens when central bank cooperation doesn't just weaken, but ends entirely. When every central bank actively works against every other central bank, not trying to maintain stability, trying to win, trying to export their problems to other countries, trying to gain advantage at others' expense. The currency volatility will explode. The yen could move 10% in a day, the euro could gap 5% overnight, the yuan could break free from managed depreciation and fall 20%. These aren't gradual adjustments. These are violent dislocations, the kind that destroy import-export businesses overnight, the kind that bankrupt currency hedges, the kind that freeze international trade. Carry trades will unwind catastrophically. There are trillions of dollars in yen carry trades. Money borrowed in Japan at 0%, invested in US bonds at 5%. If the yen suddenly strengthens, if it moves from 150 to 120, those carry trades lose massive amounts of money. 30 trillion in carry trade exposure unwinding simultaneously will crash every market it touches. Japanese stocks, US bonds, emerging market currencies, everything connected to carry trades gets destroyed. Trade wars will intensify. When currencies are weapons, trade becomes warfare. If the yuan falls 20%, the United States will impose tariffs to offset the advantage. If the yen stays weak, Europe will retaliate against Japanese imports, tit for tat, escalation. The kind of trade conflict that destroys the global trading system. The kind that led to the Great Depression in the 1930s, when countries tried to beggar their neighbors through currency devaluation and trade barriers. Capital controls will emerge when currency chaos becomes too severe. Countries impose capital controls to prevent money from fleeing. China already has extensive controls, but imagine if Europe or Japan imposed controls, restricting money from leaving, trapping foreign investors, freezing capital, and this would shatter the global financial system. Capital needs to flow freely to allocate efficiently. Controls destroy that. They fragment global markets into isolated pools of trapped capital. The dollar's reserve status will fracture, not end completely, but fragment. The world won't have one reserve currency. It'll have regional reserve currencies. The dollar in the Americas, the euro in Europe, the yuan in Asia. This fragmentation will make international trade more expensive, more complicated, more risky. It'll reduce global trade, reduce efficiency, reduce prosperity. The system that enabled global growth for 80 years will break into competing monetary blocks. You cannot run a global trading system without currency stability. You cannot have currency stability without central bank cooperation. You cannot maintain cooperation when central banks pursue contradictory policies for contradictory reasons. You cannot prevent competitive devaluation when every country is trying to export their way out of economic weakness. The math doesn't work, the politics don't work, the system breaks, and the breaking has already begun. The Federal Reserve prioritizing inflation over global coordination isn't wrong in isolation. The European Central Bank prioritizing European growth isn't wrong in isolation. The Bank of Japan being trapped by debt isn't wrong in isolation. The People's Bank of China trying to stimulate their economy isn't wrong in isolation. But together, these policies create chaos. They create unsustainable currency movements. They create trade imbalances. They create the conditions for crisis. And there's no mechanism to coordinate anymore. No willingness to compromise. No shared understanding of the need for stability over advantage. In 1971, the collapse of Bretton Woods led to a decade of stagflation and currency chaos. In 1997, the lack of coordination led to currency crises across emerging markets. In 2008, coordination prevented complete collapse, but only because central banks still had trust in communication. Today, that trust is gone. The communication is broken down. The next crisis will hit a fractured system. And fractured systems don't respond well to crisis. They shatter. 3 examples of central bank cooperation collapsing. 3 periods of monetary chaos, currency volatility, trade wars, economic destruction, and right now, in 2026, the cooperation that held the system together for 80 years is ending, not because of war, not because of explicit conflict, but because every central bank is pursuing policies that contradict every other central bank. Because the shared commitment to stability has been replaced by national interest, because the architecture of coordination has been abandoned, the fracture is happening. The monetary system that enabled global prosperity is breaking apart, and most investors have no idea what's coming. They think currencies are just numbers on a screen. They don't understand that currencies are the foundation, that when the foundation fractures, everything built on it collapses. Trade, investment, banking, markets, all of it depends on currency stability. All of it depends on central bank cooperation. And that cooperation just ended. If this showed you something about the global monetary system that you didn't understand before, if this revealed the fracture that's happening beneath the surface, you need to subscribe to this channel immediately. Hit that subscribe button right now, smash that like button, because when this monetary fracture becomes obvious, when currencies start moving in ways that shock the financial media, when the lack of coordination triggers the next crisis, and no coordinated response comes, you'll understand why. You'll know that the cooperation ended in 2026, that the central banks chose national interest over global stability, that the system fractured before the crisis hit. The warning signs are everywhere. Policy divergence, communication breakdown, currency warfare, the pattern is repeating, the cooperation is collapsing, and the global monetary system is fracturing in real time. Make sure you're subscribed, because this is just the beginning. The fracture will get worse. The consequences will compound, and you'll want to understand what's happening as the world you thought was stable reveals itself to be anything but.